2%. Well, let's get out now to Ashraf Laidi, who's Chief Global Strategist at City Index. Ashraf, let's start with the jobs data, why don't we, and the impact this is having on the currency markets. We, as discussed with Steve and our guest earlier, had been guided by Bernanke, I think, to expect some volatility in these jobs figures. How much impact is this having, though, on risk appetite and expectations of more QE?
It is successfully having an impact in the sense that the market is quite positioned in a way that it seems to have more of a downside surprise when on any signs that there might not be any QE like we saw in the minutes. So the market is more likely to move faster on the downside, risk off, rather than risk on whenever it discovers signs that more needs to be done or more QE will be done. So what was quite strange is that we saw the FOMC meeting, the actual FOMC, a month ago, and that led to a risk off for around 24 hours. Then risk on continued, and the dollar continued on the downside. Then we had the famous speech by Bernanke saying that the labor market is not fixed and more needs to be done. We had risk on. And then we had the minutes as if the Bernanke speech never existed. Why did the minutes do? And the minutes said because there were a few members that were sort of against QE. And they didn't leave it just there. They said in case there is renewed weakness. So what it seems to be the market here is quite positioned more towards downside in the US dollar, but on a modest basis, meaning not more than 133 or 134 in the euro.
Okay, so the euro is at 131, as I'm just checking in on it now. Where do you expect this to move in coming days?
Look, if we take a step back and look at the way the euro has been behaving, it's been very hard to go above those key levels of 135. So what the market here is getting overbought euros very quickly and overbought US dollars very quickly. So there is not much done here between 134, let's say. Actually, to be on the safe side, the key moving average is 135 and around 129. I think the market is going to pay attention a little bit less to the speeches of the Fed, look at earnings seasons, look at the potential for surprises there, and then until it goes to the very important FOMC meetings of this month, which we think is going to deliver more of the same, meaning that they are ready to do more. And yes, we think there will be QE, but QE with a twist. Now, if it will be the same thing as this time last year, when it was announced that we're going to have a twist, the market did not like that very much because there has been no net purchases of bonds, no new net purchases of bonds, and the market not like that. If we get the same thing later this year without any follow-up growth from the BRICS and more rate cuts from the BRICS, we might see more downside in the markets, or we might see more upside in the US dollar in late Q2.
David, let's bring you in at this point. More QE with a twist, Ashraf is speculating on from the FOMC. What's your view?
Well, our view will still be more in the way of MBS, so borrowing MBS basically to get some borrowing costs down for home loans. Because one of the interesting things about the US is that although the housing market appears to be slowly but surely recovering, at the end of the day, borrowing costs for homeowners are still very, very high, particularly when you compare across here to the UK. So we think buying MBS is the more natural thing for them to do.
Yeah. Ashraf, I just want to pick up on another point that you made, that market's going to be looking at the earnings season, which is starting imminently. Do you think we'll have positive or negative surprise from the health of corporate America in particular? Because that's what you're referring to.
Well, you know how it goes with the earnings. It's always comparing to the expectations as far as earnings and as far as sales, or basically revenues. And the third element is the guidance. So there's a lot for the market to get its hands on. And so, but people are going to these earnings season expecting to be the weakest earnings in around to 3 years. So there might be more upside surprises there. We have to go that we're going into an earnings season that is based on a strong dollar, the strongest that the dollar has been in around 2 years. So the conversion impact there, or the translation element of the U.S. dollar on the U.S. multinational, might be more of a negative than a positive, and people are going to talk about organic growth, and so there will have to be talk about the actual sales revenue or sales growth that will have to surprise on the upside.
Okay, Ashraf, thank you for that. Ashraf Laidi, Chief Global Strategist
Thank you.
at City Index.
David, let me just